The Canadian real estate market is entering into a new phase, and the cracks are no longer subtle. Vancouver real estate prices just dropped to a more than 2 year low. Rental demand is softening at an increasing pace. Landlords are offering months upon months of free rent just to fill units. Real estate investors are pulling out and removing capital. Home prices in Toronto, well, they've wiped back prices all the way to 2020 levels. And the labor market, yeah, weakening fast. At the same time, more Canadians now are giving up on even trying to save for retirement, buried under the cost and increasing costs of just day to day living. What we're seeing isn't just a few market adjustments, it's a structural shift in how housing, money, and the economy are interacting. In this episode, we're going to break it all down and share the entire August 2025 Vancouver real estate market update. Let's start with the rental update because this feeds into a lot of the narrative of what's happening in the landscape today. And this is markedly in Toronto because Toronto is really the most interesting, quote unquote, area of real estate right now. The latest numbers from Urban Nation show a real shift in what's happening in the rental dynamics there. So in Q2 of 2025, 65%, 2 out of 3 newly built rental buildings across the Greater Toronto Hamilton area were offering incentives just to attract new tenants. And that's a big jump from just 36% last year. And we're not talking about like small perks either. Nearly 40% offered upwards of 1.5 months of free rent, and almost a quarter were offering 2 full months of free rent just to get them in. Last year, that number was just 4%. That is a massive change in how landlords are now trying to entice people to rent from them, how they're trying to fill these units. On the surface, average rental rates, they haven't moved much, right? They're sitting at about $4.06 per square foot, or around $2,900 a month for your average 716 square foot unit. But when you factor in those incentives, that's when you start to see that shift. The real rent being paid is closer to about $3.56 a foot, which actually is down about 6.5% year over year. When we zoom in a little closer, in Toronto, incentive adjusted rents dropped 7.2% from last year. And in the 905 region specifically, they're down 4.7%. Thing is here too, that's just a snapshot of today, but supply is coming online fast. In the first half of this year, over 3,150 new purpose-built rentals reached occupancy. That's 77% more than last year and about 50% higher than 2023. And as a result, and understandably, these vacancy rates are rising. 3.5% overall across stabilized buildings, 4% in the 905, and 3.2% in Toronto proper, right? I remember in Vancouver, we've touted sub 1% for a long time. To see that go up to 3s and 4s is very notable, and that will have a seismic shift. And it's a clear sign that rental demand is softening and landlords are starting to compete harder and harder for tenants. So while face rents may appear flat, the real story is the incentives, and they're growing fast. This is a great time for tenants, right? They can obviously shop around, they can negotiate in their favor for cheaper rents, longer term incentives, more incentives, etc. The other side of that coin is that we are going to see less and less investors and speculators coming in and buying things like pre-sale condos that ultimately are the largest source of rental houses in Canada. As we've touched on in previous episodes, there is a record amount of purpose-built rentals currently under construction. And as those complete into a softening market, you're going to start to hear stories of how developers may not even be able to potentially profit from building purpose-built rentals, right? Remember, a good number of developers who had projects underway that were going to be for end users had to shift their plans into rentals just so the numbers could pencil, so they could at least pay their employees, their construction workers, and ideally even make a little bit of profit. So when we see end user homes not penciling and purpose-built rental numbers now declining, the future of home construction in the immediate future in this country is at a serious risk.
You got to wonder too, Dan, what portion of those rentals were units that couldn't sell? And I often wonder to what degree we're going to see that increase. I think it's going to increase quite dramatically, especially in high dense areas. But let's take a look here at job vacancies, because this isn't great news either. As more people within the housing industry see their projects complete, or they're just ending up getting straight up let go after these buildings getting complete, and their jobs, these sales positions, they're evaporating, and they're walking out into a tightening job market when they're looking for new work. I mean, BMO just reported that job vacancies have collapsed to an 8-year low, well below the pandemic rate. While the US appears to be stable for now, Canada's labor market is eroding much faster and approaching a recession style situation. The seasonally adjusted job vacancy rate fell to 2.7% in May, down zero point 0.1 points from a month prior, and down a half a point below last year.
And so as people are seeing the cost of living go up and the job vacancy rates go down, life is just going to get harder and harder. And what's coming out of that, the result is that more and more Canadians are essentially they're choosing lifestyle over long-term savings. A new 25 survey that just came out from IG Wealth shows that 46%, almost half of non-retired Canadians are prioritizing their lifestyle today rather than saving for retirement. And, it's a conscious, life's too short / YOLO mindset. But realistically, for many, it's a financial necessity, right? Think about this. 38% from this poll said they are too deep in debt to even think about saving. 56% have either delayed or completely stopped saving for retirement. And a staggering 80% say the rising cost of living is the number one barrier to building any kind of nest egg. Right now, the average Canadian is spending 67% of their income on essentials, 20% on lifestyle, and about 12% remains for retirement. And that's the average Canadian, right? But for a lot of people, that math simply doesn't work. And even though nearly half of Canadians still hope to retire by the age of 65, the reality is hitting hard, right? About 1 in 3 expect they'll have to delay retirement just to cover basic needs, earn extra income, or stay socially connected through work. Take this real example. A 58-year-old Toronto woman just told the CBC that she had planned to retire soon, but then her rent jumped by $3,600 a year. And now what? Well, she quote, "I thought I'd be gardening by now, but I'm actually looking for a part-time job." Just one example, but you get the idea here, right? And this isn't just a retirement planning issue. It's becoming a lifestyle crisis. I mean, the cultural message of live in the moment is colliding with the brutal cost of just trying to get by. So if Canadians can barely cover today, I mean, how can they prepare for tomorrow? And ultimately, this isn't just a budgeting issue. It's a slow moving national financial emergency is what it feels like, right? Canada could be headed towards an aging population with fewer resources, a government under pressure to provide more support, a younger generation with limited access to capital and assets, and ultimately a society where long-term stability is the exception and not the norm, right? We just talked, I think it was last week, about how more and more aging Canadians expect to go into the retirement years still carrying a mortgage just because they have to, or they have to tap into home equity just to cover some of the day-to-day living expenses. Ultimately, it's been quite a challenge to find any positive economic news in the headlines lately. The bad news appears to be basically compounding. So what does this all mean for real estate? Let's dive into the most recent numbers.
Yeah, we'll start with the GTA first. Just before we get into July, the numbers for July, that is, the data out of the the Greater Toronto area is what we wanted to share. It's in all the headlines here. So sales volumes hit a 4-year high for the month, rising 11% year over year to 6,100. It sounds good maybe in a micro snapshot, but the big picture is that that's still 21% below the 10-year average. And while prices dropped 1.4% month over month, and they are down now 5.4% year over year, bringing the composite benchmark to 981,000. So when you actually look at what's happened since the peak, that's a drop of nearly 24%. And from what I've looked at, that's actually one of the largest housing corrections we've ever seen. That since February 2022, that is. Seeing homes lower by an average in dollar figures of $301,900. Toronto home prices are flat out back to 2020 levels, almost entirely erasing the massive increases during COVID. So they have increasing momentum into a price declining market. And what's more is inventory continues to climb. There were 16,665 new listings. That's up 5.7% year over year, and the second largest July on record. This pushed total active inventory to a new all-time high for the month of 30,220, a full 9% higher than the previous peak in 1995. And Dan, I just want to touch on something before you jump in here. That jobs report and people that are going into retirement with a mortgage, 2 decades ago, it was 8% of Canadians. Today, it's 28% of Canadians, right? So and then when you compound that with what's likely going to happen with the introduction of AI wiping out sort of these jobs that are easily repetitive, this is a much bigger problem than we've been preparing for as a country. We're not ready for this, and it's going to hit hard.
So let's see how Vancouver compared, because we see these two major cities acting somewhat in comparison, though understandably, and for some time now, Toronto has kind of led the way, been dubbed the epicenter of the downturn. But here's what happened in July for Vancouver, because there's something, as we mentioned last week, that has never happened before in history. So let's dive in. Total sales, right? What is the health of the market? Interestingly, last month, July, saw the highest amount of home sales in all of 2025, and also the highest in 9 months. There were 2,286 units that sold last month. It is 2% lower than we were a year ago, which again is already a slow year. And so big picture, last month's sales, while the highest of the year, were still 14% below our long-term 10-year average. Ultimately, it was the slowest July dating back to 2019 outside of COVID. So there's no sign of any notable increase really. But here's the headline, is that for the first time in history, July sales were more than June sales. And that goes back to 2005, and it does eliminate the coming out of COVID, which was from zero upwards basically. So that's a very, very unique shift that we've never seen before, and is obviously worth paying close attention to, especially when we get into the further numbers and as things sort of compound and accentuate. Also, on a sales dollar volume, it was the highest of 2025, and it's actually a 9-month high as well, the highest since October of 2024. Last month in Greater Vancouver, there was $2.84 billion worth of real estate that traded hands. So a lot of unique things happening in just the sales volumes element of last month's report. Could be unique, could be an outlier, but imagine if we saw it increase in August. I mean, come on. Since when is July the hottest sales volume month of the year? Again, it's never happened. So we will keep you well informed on that.
I don't know. It doesn't really add up. Like the cycles that we have historically seen, none of them are getting repetitive anymore. And I don't know if that's due in part to COVID, or that's due in part to this sort of disinflationary disinflationary model that we're in right now. And I do think it's going to continue myself. I think that's a bit of a blip on the radar. I think August is going to be very slow, but we'll see. Let's have a look here at new listings. Declined now for the third straight month in a row. We're at 5,660. That is still about 1%, 0.8% higher year over year, 11% lower than June, and 12% above the 10-year average.
So what has that done to inventory? Well, inventory did something unique as well. Inventory actually lowered for the first time in all of 2025. And ultimately, it lowered in July. That is normal behavior. That is somewhat expected. So active inventory sat at 16,555 at the end of the month. It dropped about 5% month over month. But again, always have to reference the big picture, because that really tells a much more broad story. From last year, inventory was up 20%. So it's big there, but let's go 10-year average now. It's even higher. We're 40% above the 10-year average. So still a lot of inventory out there right now.
And the sales to active ratio is not looking like it's chewing into any of that. Overall, we're still sitting in a balanced market at 14%. It's up about 1% here, but this is 14 months now in a row of a balanced marketplace. And when we break it down into asset class here and we look at detached homes, there's been no move, sitting at 10%, still well inside of buyer's market. When we look at townhomes, they're performing the best here of all three asset classes at 18%. But again, that's no move from the prior month. Apartments have improved a little bit here at 16%, up about 2%, but overall, basically no move in consumer sentiment here.
So where we saw something else interesting happen last month was in foreclosures. Now, as we reported last month, the arrears rate was the same. It was flat. And British Columbia has one of the lowest arrears rates in the country. But BC saw a notable jump in the amount of foreclosures. They went up a total of 45 units, and we're sitting at 350 total right now. That does equate to a 14% month over month jump, which is by far the most that we have reported on since tracking this about a year ago. It's easily the highest increase we've seen month over month in a year. When we look back to when we basically started this, October of 2024, there was 230. So we got like a 50% increase in the total number of foreclosures since then. Again, on a total inventory basis, it hasn't moved much on a percentage, but a 14% jump month over month is absolutely notable, and we'll see if that continues because it's unusual and notable. Outlier or the beginning of a trend? We'll know more soon.
Yeah, that's kind of scary. Looking here at how long it's taking to sell your home, so your days on market here is sitting at 24. That's up another 3 days from last month, and we're now looking at the fourth monthly increase in a row of how long it's taking to sell your home.
So price, yes, the whole theme of this is downward prices right now. And HPI dropped for the fourth straight month in a row, dropped about $8,000 or 0.7% month over month. HPI is now down 2.7% year over year and is sitting at 1,165,000. But, it's been dropping for, again, 4 months now. And it actually puts home prices back to March of 2023. That's a 28-month low, over a 2-month low in HPI prices. Over a 2-year low in HPI prices. Median kind of led the way here, right? After it increased for 5 months in a row, it dropped 52 grand and is sitting at 933,000. Average dropped as well, 32K down to 1,243,000. So we're looking at a 2-year low in prices in Vancouver, basically a 4.5, almost 5-year low in Toronto for prices. I mean, the thing that I wanted to really touch on here is the fact that we are seeing increased sales volumes into increasing rate of price lowering, price decreasing. Is that going to be a trend? Because if that train starts to increase speed, then, look out below kind of thing. Obviously, we don't know where this is going to go, but at this point, when you see an increase in sales volumes into a lowering price environment, it could be a foreseeable future where prices continue that trend, especially going into summer where things like really quieting down. No rate reductions in the foreseeable future here. So we're leading up to what is going to be an always interesting market. Ryan, what's your take on the next couple months here?
Well, for August, I really don't think we're going to see much in terms of action in August, just from the conversations and the boots on the ground experience we're having. Investment, outside of perhaps the multiplex space, that has all but evaporated. You're seeing a lot of end users. They're the only ones, people who are going through life events, things like that, or people who are trying to relieve themselves of vacation properties. That's, we're still seeing that, but there's just no real appetite to really kind of get in, and there's no haste. So I think, August is going to be pretty slow. September, I think, could be, maybe a correction month, but I really don't. I'm not convinced with everything that we're seeing. I mean, we just went through an entire list of economic signals. This isn't noise. These are signals, all pointing to the downside. So for me, I actually, when I sort of zoom out like 30,000 foot look and I go back to like 2008, where you saw the US have a huge housing correction, we didn't have that here. And I almost wonder if the banks came in and, saved Canadian real estate, and now we're actually paying the price for that plus COVID. which is kind of a scary thought. So I don't really know how this is going to go. But right now, if you're a buyer, you've got loads of opportunity. If you're a seller, you're going to it's going to be pretty tough, and you got to be really realistic with selling. These 2022, 2021 prices that you've heard of, they're gone, just gone. So if you really are interested in selling your property, you got to get real with the data, and that's exactly what we're talking about here.
So that is it. That is what is happening this month. And, I'm glued to this. I'm checking the numbers daily here because it is just moving so fast and so interestingly and in such a unique manner. So as always, we are here to help. If you're curious what's going on in your pocket, your neighborhood, or your target area, please feel free, reach out, book a call with us. We love talking about this stuff, nerding out on the data, and just hearing more about what's happening on the grounds with other people. So feel free to reach out anytime. Thanks as always for watching. Have a wonderful weekend, and we'll be here next week. Bye.